In today's video, I'll be giving you a complete beginner's guide on investing in the stock market. You might have heard of people becoming millionaires from putting their money into companies like Facebook and Tesla, and you want to be a part of some of these profits, but you're not quite sure where to begin. Putting your money into something like the stock market can seem like a daunting, complicated, and even risky process. You might be worried about losing all your money or having to set aside hours and hours of your spare time researching companies, or even just the fear of putting your hard-earned income into something that seems very unpredictable and could ultimately just cause it all to vanish. But it's very accessible to everyone, no matter how much money you have or how much time you've got to look into it. The whole process of actually buying shares is very straightforward and a lot less complicated than you might think. It can be done in a few minutes once you know what you're doing, and the learning curve to get there is very short and actually something that can be learned quite easily. By the end of this video, you'll know exactly what the stock market is, how to invest in it, and most importantly, the exact steps on how to make money from it. I'll break down investing into small bite-sized pieces that will make it a much easier concept to understand. I'll also be showing you how you can get a free stock or get a free top-up of money to get you started with your investing journey. I've got a referral link for Hatch and Sharesies, and finally with Stake, you'll get a free stock either for Dropbox, GoPro, or Nike, and currently the Nike stock is valued at $160 US, so check out the links down below in the description if you want to get a bit of free money or a free stock when you're first signing up to one of those three brokerage platforms. First of all, what is a share? A share is essentially a single unit of ownership in a company. A company is broken down into multiple shares, and these are offered to investors which can purchase them, and then once an investor buys a share of a company, they become a shareholder or an investor in that particular business. And the reason that companies do this is because it's a way to raise capital. They will get money from people with the belief that the value of those shares will increase, and therefore the investor will make a profit from giving their money to that particular business. So the more capital or the more money that a company has, the greater its ability will be to grow the business. They can use that money to create more warehouses, build more products, hire more staff, to ultimately grow the business to a larger scale. When you put your money into a business, you are essentially a part owner in that company. So how do you make money from the stock market? Essentially, once you give your money to a business, the percentage that the stock price rises will reflect how much money you make from your investment. So if you invested $1,000 into a company and the stock price went up by 10%, then you would have a 10% gain, so you'd have a profit of $100. Because you financially help that company with its growth by giving it a portion of your income, the profits will be shared with the investors. And aside from capital gain from the investment, so the investment going up in value, you can also make money from dividends, and this is when a portion of the company's profits will be paid back to shareholders, and the amount that's paid back to you is reflected in how much you've invested in that company. So different businesses have different dividend yields. The lower end is anywhere from say 1 to 3%, and then some can be even as high as 7%. Dividend investing is very popular because it's a form of passive income, but you do need to be careful with the types of dividend stocks that you buy, because a high dividend doesn't mean that it's necessarily a great company, because what can happen is that a company might just have a very high dividend to lure in shareholders, but it can't actually afford to pay out that dividend, and it's financially hurting the business to pay that much of its profits back to its investors, and this overall limits the growth of that company. So that's something to keep in mind if you're looking at investing as a source of passive income. When it comes to what makes the price of a stock go up or down in value, in the long run, it's largely related to the financials of that company, its revenue, number of sales, cash flow. These are the indicators that show the financial health of that company, and the better that these are, the more investor confidence there is in that business, and then more people will buy into it because they know financially that company is doing very well, they're using its money wisely to grow the business, and therefore if they invest into it, they'll use the investors' money wisely, and they'll be able to make a return for those who are willing to invest in their company. In the short term, people's opinion plays a massive role in whether or not the price of a stock can go up or down. So a great example of this are some of the meme stocks that have come out, like GameStop, AMC, BlackBerry. There's nothing special about the company's financials, but with say GameStop, it's gone up over 1000% in just a few days, but the price of that stock has dropped just as quickly. So there's nothing tangible actually making the price of it go up, just people's opinions and a lot of hype and speculation speculation about that particular business, that's an example where in the short term speculation and hype will influence the price of a company. But if you're looking at something as a long-term investment, the financials of that business are far more important, because that's where you can get the confidence that you can actually hold on to that company over a long period of time, say 5 or 10 years plus, which is ultimately what you're trying to do if you're investing. If you're just looking at things like GameStop and AMC, you're more or less just gambling with your money and not investing it. So what stocks should you buy? This really comes down to how much risk you're willing to go through with your money. So the two main types of investments that you can get are ETFs and individual companies, and which one you pick is basically related to how much time you're willing to invest looking into the stock market and how much risk you want to take with your money. Starting with ETFs, these are exchange traded funds, and this is basically an investment vehicle that has a particular goal. So you might get one that will track a specific commodity like gold or silver, or a specific sector in the market like healthcare or technology. And then you might get one which will track the overall performance of a company's stock market. So one of the most popular and best investments that you can get, one that some of the best investors in the world will stand by, such as Warren Buffett and Ray Dalio, this is of course the S&P 500. And just to give you a bit of context on what this is, essentially it's the top 500 American companies. Think brands like Facebook, Coca-Cola, Google, Amazon, all of these big branded American businesses, and they're all clustered into a single investment. So if you put your money in there, you might have 2% in Google, 5% Amazon, 3% in Facebook. So you have a very diversified portfolio that's spread out amongst the top 500 biggest American companies. And because your money is spread out amongst all these businesses, it's very low risk, but the return is not huge. It gets an average of 10% every year, but some years it might go up 30%, other years it might go down 2%, and overall as an average over a 30 plus year time range, you'll get a return of 10% year over year. The great thing about something like an ETF is that it takes no time and no maintenance. You don't have to spend any time researching companies or looking at their financials. It's just a very set and forget strategy, and this makes it very appealing for people who are new to investing. It takes no time, it's very low risk, and it has a very consistent return of roughly 10%, which doesn't sound like a lot, but if you add that up over 10, 20, 30 years, it can quickly compound and give you an excellent return. And if you're someone who's more comfortable with risk and actually wants to set aside some time researching businesses and looking at their financials, then putting your money into individual stocks is the way to go for you, because with this you could get 100, 200, 300% return if you pick the right company and spend enough time researching it. But then your money is tied to one business, so if that does poorly, then you'll be losing your money from your investment, and you're more susceptible to the ups and downs of the stock market because all of your money is just tied to one particular company, and you actually have to spend quite a bit of time to thoroughly understand that business so you can make sure that it will be a good investment. So why should you invest? Investing is essentially a great way to protect your money and make sure that it holds its value. If you look at the average rate of inflation, which is roughly 1 to 3% every year, and this is just essentially how much buying power your money loses year after year. If you look at the prices of commodities like petrol or housing, you can see how much they've gone up over a 20, 30, 40 year time period, and this is because of inflation. If you have your money invested in something like the stock market, it doesn't go through that burden and actually holds its value and is able to actually gain value over time instead of losing it. And the amount of return that you'll get in the stock market is substantially greater than what you would get with a bank. A high profile savings account is only anywhere between 0.5 to 3%, and then if you look at inflation, this can automatically cancel it out, or you might even be losing your money from having it sitting in a bank in a savings account. The average you can get in the stock market, and a low end return at that, is 10%, so that is unmatched by any savings account, and this is what makes investing in the stock market so beneficial if you're someone who wants to look after their money. So just jumping behind the computer screen, I'll give you an exact step-by-step process of what it would look like to actually buy shares in a particular business. So the brokerage platform I'm using right now is Hatch, and if you're wanting to actually buy shares in a company, you'll need to set up a brokerage platform. So for me in New Zealand, you've got Hatch and Sharesies. Over in America, you've got Robinhood, and then in the United Kingdom, you can use Webull. There's obviously a lot of other other brokerage platforms that you can get, but those are some of the most popular ones if you are investing in those particular countries. When you're signing up to your broker, it's pretty much the same as making a Facebook or Instagram profile. You'll just need a few regular pieces of info like your email address and phone number, and then a few extras like a proof of identity, either your driver's license or passport, and then you'll often need a verified certificate of your bank account. So just sending through a photo of your bank statement, and all that needs to get verified so that no fraudulent activity takes place on the brokerage platform, and then your account will be all set up and verified and you'll be ready to buy some shares. So this is what it looks like on the majority of investing platforms. It just has all the companies laid out and you can click on whatever one you're interested in purchasing. So the one that I'm going to be investing into is the S&P 500, the ETF that I was talking about earlier in the video. So you just click on that particular company and then it'll give you a bit of financial info about their business, so you can see a stock graph of how well it's been doing over, say, 1 day, 3 months, or even up to 5 years, so you can get a good idea of how well that particular business has been performing. So then you scroll down here, click on buy, and then you select the amount that you want to invest in that particular business. So there's a few buying options here, but we'll just stick with market buy for the sake of this video. So I'll pop in $100 here, and then I'll just click on review market buy order, and then click on place order, and that's it. I've just bought shares in that business, and that's just taken under a minute to do. So that's how fast the whole process can be done once you've gotten over that very small learning curve of just setting up your broker and doing a bit of research on a business before you're actually looking to buy into it. That'll do me for today. Remember, if you found the content helpful, make sure to help me out by liking this video and subscribing to the channel. Now that you're familiar with what investing is and the process of actually buying shares in a company, you might want to look at the most common investing mistakes that I had to go through when I first started on my investing journey. Click on that video so you can see some common mistakes to avoid, and they will ultimately save you a lot of stress and money if you're able to avoid them when you first get started.